Welcome, 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 everyone. Thank you very much for attending today. We're very, very excited to have Kathy Scalzo speaking today about infinity banking. But before she starts, I found an article I thought might be useful to you. If for some reason you need to grab some of your money that you have in your 401k or your traditional IRA, because the government has an early withdrawal penalty exception for 2024. And the exception enables you to avoid the penalty, the 10% penalty, if you're not 59 and a half, to reimburse yourself for medical costs, college expenses, and other limited purposes. So we don't know what limited is. So you have to ask your IRA company. And you could borrow up to $1,000 for personal or family emergency expenses. Again, you'll have to check with your 1031, sorry, wrong one, IRA, with your IRA company to see what they consider an emergency. And then if you are a victim of a domestic abuse within a year from the time of the incident, an account holder may withdraw $10,000 or 50% of the account value, whichever is less. And that will be without triggering the 10% penalty. And remember, because this is pre-tax dollars, you'll still have to pay taxes on whatever dollar amount you take out. So check with your tax advisor. Always check with your tax advisor first before you pull out the money. And it's always a good idea to have a special savings account for emergencies that come up separate from your retirement account. So thank you for that. And Kathy, we're so happy to have you. Kathy is an infinity banking specialist. She has been in the business for a number of years. She studies it all the time. She comes up with new ideas and ways to make things work so that you eventually don't have to go to work. So Kathy, thank you very much for being here. Please take it away.
Well, thank you so much for having me. It's interesting that you were talking about retirement accounts because that's exactly one reason why I want people to understand the infinite banking concept is because they don't have to worry about a 10% penalty if they want to use their own money. This way they can save their money for the future and use it at the same time without interrupting their compounding growth. So I will go ahead and share my screen and get into how you can leverage whole life insurance for your life and for your investing. You
Thank
see
you.
my screen? Do you see it?
Yep, it's going well.
Leveraging whole life insurance. Well, it's not really going well because it's not advancing. Oh,
Oh,
there we go. What did I do?
oh
Well,
no.
anyways, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. That's what Will Rogers said, and he is absolutely right. Because we have been programmed to believe money works a certain way and that we should put it in the banks or stash it away in our 401ks or IRAs where we're not allowed to touch it without being penalized. But I'm here to tell you that there is a better way. So this man right here wrote the book, Becoming Your Own Banker. This is R. Nelson Nash. This book is what completely changed my life. I met somebody at an online networking event who told me about the infinite banking concept. She suggested that I read this book, and wow, it's very mind blowing. It's a whole paradigm shift. So I highly recommend that you read this book. So the fact of the matter is that the average American spends 34% of every single dollar on interest alone.
Wow.
And some of you might be saying, I don't pay interest because I pay cash for everything. But the
Mhm.
fact is, whether you pay cash or you finance it, you're still paying interest because if you pay cash, you're giving up the ability of what that money could have otherwise earned for you. So, what if you could have that 34% of interest coming back to you instead of flowing away from you? So, the typical American is either a debtor or a spender, or a saver. They'll go into debt, they'll charge something on their credit card or finance something. So say they want to buy a car, so they're going to finance it at the car dealership, right? So then they pay off the loan. And this right here is the zero line. The white line is zero. So they start at zero, they finance the car, then they're way below zero, then they have to pay off the car and then get it paid off. And guess what? They're right back to zero. And then they want to buy a home. So then they have to, go way down below that zero line. So they have to make that down payment and then pay the mortgage up, up, up. And they're just heading right back to zero, not getting past zero again. And then they want to go on vacation. So they go into more debt and never getting back to past zero. And the saver, on the other hand, is going to save up their money for that car. And then they're going to pay cash for the car. And now they don't have any money anymore. So they're back to zero. The same thing with the house. So what I like to show people is how to save and spend your money at the same time. So these are the wealth creators. So this is the line of your cash accumulation. It's only going up, 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 never, ever, ever going down. Even though you buy that car, you're just going to borrow against the cash that you're saving for the future to buy that car or to make that down payment on the house or to take that vacation. You can do everything that you're already doing in your financial life. You don't have to make any sacrifices. But the thing is, your money is just going to continue to grow because you're not using your money for these things. You get to leverage the insurance companies or use your money as leverage, use insurance companies' money to buy all your things while your money remains in this policy, earning uninterrupted compounding growth, which is tax advantaged. It grows tax deferred, but you take it out through loans and then you never pay taxes on the money. So I want to talk to you about how banks work because people will say that life insurance is a scam. I'd rather put my money in the bank where it's FDIC insured. But when you do that, say you put $100,000 in the bank, maybe they're going to pay you 4%, which is very generous. Some banks are paying that much nowadays, so that's pretty good. But your money's not just going to sit there in the vault of the bank. They're going to take your money and they're going to loan it out, say for a mortgage, and they're going to charge 7%. And then that money is going to go right back into the banking system. Oops. Sorry. So the mortgage, the homeowner puts the money back in the bank again. And then the bank loans it out again, say for a car at 8%. And then the dealership puts that money right back in the bank. And then the bank takes that same money again and they loan it out, say, for a home remodel. And then the contractor is going to put that money right back in the banking system. And then the bank's going to take that same money again and loan it out, say, for a debt consolidation loan at 12%. And then that credit card company is going to put the money right back in the bank. So what's happening here is you're getting 4%, but the bank is getting leverage and getting arbitrage on your money. So they're earning 3% on the home loan, 4% on that car loan, 5% on the home remodel, 8% on that debt consolidation loan, for a total of 20%. You're earning 4, the bank's earning 20. So it looks like the bank is earning 16% more than you, right?
Mm-hmm.
But in actuality, the bank is earning 500% more than you are on your money. To me, there is just something wrong with the system.
Well, they're doing the same system that if you were to put your money into the insurance policy, right?
Yeah, except you get to replace the bank in that case. So
Exactly.
you
There
get
you
to be the
go.
one earning all this arbitrage on all these loans. So you can save up your money in the policy and loan it to yourself for all these things, and you can be the one collecting all that extra interest instead of giving it away to the bank. So the way you're going to do this is the best way is with a dividend paying whole life insurance policy from a mutual company. Now, this whole life insurance, I'm not talking about indexed universal life because there's, different things going on with those policies that it does not work the same for banking purposes. The whole life insurance policy is guaranteed to increase in value every single year, no matter what happens to the market, no matter what happens to the economy. You're getting guaranteed growth in this policy. And you get to leverage that growth, borrow against it without interrupting it. So the strength of compounding, of uninterrupted compounding. Like, would you rather have $1 million today or a penny doubled every day for 30 days?
I'll take the penny.
Yeah, you know the strength of uninterrupted compounding. It doesn't seem like one little penny doubled just for 30 days every day is going to turn into much, but it actually turns into $5,368,000 in 30 days. So the problem when you take your money out of the bank to make a purchase is you're interrupting that compounding. So this is showing just a 100 withdrawal on day 15 and day 25. So a total of $200 withdrawal. Interrupting that compounding is going to cost you $3,280,000. So you definitely want to do whatever you can to avoid interrupting your compounding. So this chart here is an example of what it's like to use a policy for a car purchase. So this is somebody that's 50 years old that they decide to pay themselves first. Like, it's a really good idea to pay yourself first. You want to pay yourself first, ideally at least 10 to 25% of your income somewhere. I think a policy is the best place to do that. So this person's paying themselves first, $10,000 a year. So then on the third year, they have enough money here. See, they have 21,000 cash value available. So they can take a loan against that cash value for $20,000. And they can go and pay cash for that car. And then instead of paying the dealership the payments, they can go ahead and play honest banker with themselves and pay themselves back what they would have otherwise paid the dealership. So back into their policy, they pay $4,800 per year. So by year 7, the total premium they have paid into this policy plus the loan repayments equals $82,000. And they still have available in their policy $58,000. So they have $58,000 plus they have the $28,000 cars. So that's $78,000. Of course, the car is depreciated by then. But normally, if they do it the traditional way and finance it or pay cash, whatever it is, that $20,000 is just going to be gone forever and ever, never to earn for your family again. But this way, it just continues to grow for the rest of your life. So then in year 8, they go and buy another car and they actually decrease their premium payment to $4,000 because you have that option. This policy is flexible. So if you want to pay less into it, you can pay less into it. So here, after year 12, the total premium and loan repayments have been were $44,000. And now the cash value is $94,000. It actually grew $45,000 and they only put in 44. So now they have $94,000 plus 2 cars, where normally they would be minus the 40,000 for the cars.
Mm-hmm.
So this is comparing life insurance policies for different places that people put their money. And the only thing that checks off yes to almost every single one of these things, 100% is the life insurance. 100% principal protection. There's guaranteed growth. You get penalty-free withdrawals before you're 59 and a half. I don't recommend withdrawing the money from it because then you're interrupted compounding. You can take loans against it tax-free. It's tax-deferred growth. There's tax-free withdrawals, guaranteed interest, protection from creditors, disability benefits. It's risk-free. It's tax-free to your heirs. There's no contribution limits except up to your insurability. And there's uninterrupted compounding interest and a death benefit. None of these other things, CD, real estate, mutual funds, 401k, stocks, Roth IRA, 529, none of them have close to the amount of benefits that the life insurance does.
Mm-hmm.
So I am not saying that you should invest your money in life insurance instead of real estate. So life insurance itself is not an investment. It's simply a place to store your capital that you can use for your investments. So when you're investing in real estate, instead of just earning whatever it is you're going to earn in real estate, you get to earn in the policy at the same time. So you're basically double dipping. So you're earning in your investments and your money is growing in the policy simultaneously. Not to mention the death benefits. Many people who invest in real estate say they do it for generational wealth. Well, the second you make a premium payment, you instantly create generational wealth. And the more premium payments you make, the more that death benefit increases for your heirs. So I use the car example, but that's not necessarily the best use of the policy, because if you're a real estate investor, you probably don't want to give up what that money could do for you. So it still might make more sense for you to finance the car if you can get a lower interest rate, because you can take that money instead and put it into one of the opportunities that Peggy has maybe and earn 10, 12% interest, or you can use it for a down payment for a house. So you just have to decide for yourself the best use of that money. But it's called infinite banking is because there's infinite possibilities of what you can use it for. So ideally, it's just an one extra step. It's not like diversifying your portfolio or anything. It's not doing this instead of that. It's in addition to whatever you're doing. Put the money in the policy first and then make whatever investments you want to make. Or you can actually use it to get out of debt. Like one of my mentors was able to, he had over $900,000 of debt. And he was able to use this policy and get rid of all of that debt in just 39 months.
How many months?
39 months.
Oh my God.
Yeah, because you pay off one debt and then you take what you're paying on that debt and pay it back into the policy instead of the creditor. And then as you keep adding, more and more debts, then it ends up, actually creating wealth while you're getting out of debt at the same time.
It's brilliant. Wonder what Randy, what's his name, has to say about that. Is that his name? You know who I'm talking about?
Oh,
Dave Ramsey.
Dave
oh
Ramsey.
yeah.
Yeah, Dave Ramsey. He
Yeah.
doesn't like anybody to be in debt.
Nope. He has really great tips for people getting out of debt for sure, but he doesn't help people build wealth. Like being out of debt is not financial freedom.
No.
And he will tell you that whole life insurance is the biggest scam. It's the worst place to put your money. But
Really?
yep.
I'm sorry to hear that.
But I'm pretty sure he has a whole life insurance policy from what I hear. But
Hmm. So I
yeah,
have a couple questions. Are you ready for questions?
I am.
Thank you for that presentation. That was great. And I always am thrilled when it brings up questions. One of the things that when you brought up about that 34% interest that we're all paying, and that then you showed the penny, thinking Warren Buffett, man, he was what I would call a penny pincher, as many would call him, because he didn't like to give that penny away. There's a story in the book Snowball about how he was with Katharine Graham of the Washington Post, and she wanted to make a phone call. They didn't have cell phones back then. So he didn't have a dime, he only had a quarter. And she said, that quarter will work, I'll take that. And he was just really upset about that 15 cents. He did not want that 15 cents spent because he thinks what that 15 cents could do for him in the future. Like, I just
Yeah.
have to laugh. But, serious for him, seriously, that's how he thought. That 15 cents could turn into, like you showed when you had that interrupted of pulling the money
Compounding.
out, that was a $3 million loss. So that's just how he thought about money. I thought that was great.
Yeah,
So,
that's what people think. They think, oh, I'll just go to Starbucks every day, whatever. It's just $5, no big deal. But then, that adds up. And then over time, you're talking probably millions of dollars of lost wealth because you made the wrong decisions.
yeah, wouldn't Starbucks, if you passed on Starbucks and bought a $8 pound of coffee, and that 30 days, how many cups of coffee you didn't drink from there, but it paid for your policy at
Yeah,
$5 a day? I bet that would pay for your policy in a month. 5 times. I'll
yeah,
have to do the math on that.
could
So,
almost for a
so I
young
had
person.
another question, and that was, so you did bring up, so the So took me 12 years, and I presume I could put more in than $10,000 a year, but so I built up to 94,000. Now I could lend that money I could be a lender on that, or I could invest that in real estate, or I could, if it was even $10,000 and I could find an investment, I could borrow that against that money,
Mm-hmm.
against that policy. So I'm not touching the money in the policy. I'm
Right.
borrowing against it. So I'm actually borrowing from whatever company, whoever the policy is, John Hancock or whoever, New York Life or whoever they happen to be.
Mm-hmm.
And so now I could borrow that money and lend the money out at 10 or 12% while I'm earning. What are they gonna, they're gonna charge me something, I presume.
Yeah, it's around 5%, depending on the company. But you're
Okay.
paying full interest when you borrow the money, but you're you're not touching your money, so your money is growing with uninterrupted compounding growth because the insurance company is paying you a guaranteed interest rate on your cash value plus dividends on top of that. Dividends are not guaranteed, but they've been paid every single year for over 100 years with these companies. So don't know why they would stop.
Okay,
So
so they're gonna pay me on my policy. Let's say I have $100,000. Am I getting 5% or a little bit more if I'm
a little bit more with the dividends added
okay?
in.
So I'm getting $5,000 a year. Am I getting paid that 5%? Am I getting paid that monthly or quarterly, or how does the insurance company pay me that interest? When
They
does it show up in my account?
It gets credited annually.
It gets credit. So I get the $5,000, let's say on December 31. And now
Hmm.
that $5,000, I have $105,000. And now that 105,000 is,
Right. Yeah. And
I don't get it all year long to compound.
well, well, the dividend's not compounding all year, but the cash value is compounding throughout the year. And the
Okay.
dividend is paid out every year.
Well, the only way it could compound is once the dividends in there.
We have interest too,
Well, that's
the
what I'm
guaranteed
talking about,
interest
the
that they're
interest.
paying.
So when does the interest get put into the policy? Is that quarterly or is that annually?
It's annually also, but it's
Okay.
still compounding every year. And then it's a it's kind of a wash between what you're paying and what you're earning, although you're earning compounding. But when you play honest banker with yourself and you pay yourself back, just like you
Uh-huh.
would if you borrowed the money from a financial institution, the amount of interest that you're paying decreases because your balance is decreasing on what you owe. Whereas the
Right.
interest you're earning is only increasing because your cash value is always increasing.
So then I make a profit on my $100,000. Let's say I make 12,000 a year. I'm paying back the 100,000 out of that money, the
Hmm.
12,000 back, right? Because I'm making payments. Are there any taxes on that 12,000 I just made of interest? Because I'm lending, let's say I'm lending 10, whatever, I'm lending $100,000. I'm getting paid 10 or 12% a year,
Hmm.
but I owe the company the money. So does that offset? Because I'm paying interest to the company, that should be offsetting the 10 or 12% I'm earning, right?
You can talk to your tax preparer about writing off that interest possibly that you're
Okay,
paying in order to make your investments. The
great.
money that you're earning in your investment outside the policy is not going to grow tax free because it's outside the policy. But the what you're earning in the policy is tax deferred, which is accessed through tax free loans.
Right. And usually the income is offset by the what's owed. So yes, we got to always talk to our accountants, our tax advisors about that.
Yeah.
Jonna, hi, Bruce.
Hi, Kathy.
Hi.
Thanks for that presentation. I wanted to, I was unclear when you and Peggy were talking, it's related to that subject. So on your cash value, there's a death benefit and a cash value, correct? So the cash value is growing, and that's what you're talking about borrowing against. Is that correct?
Well, the cash value is actually a portion of the death benefit that's available to you while you're living.
Okay.
Like there's a lot of people object saying, well, the insurance steals the cash value. If I pass away, my heirs only get the death benefit and the insurance company keeps the cash value. But the cash value is a portion of the death benefit. So they're
Okay.
not stealing anything.
You want to see that slide again, Jonna? Would that be helpful?
No, I understand what she's saying, but that is, I think, an important clarification. So they're paying on the cash value. I'm just trying to make sure I understand correctly. The cash value, they're paying dividends and interest? Is that?
Yeah.
Mm-hmm. And about what is and the interest is a fixed rate?
Yes,
and
it is.
What's the rate going at?
With the company I use the most, it's guaranteed 3.25%. Of course, it's not sexy like an investment because it's not an investment. It's just a place to store the capital. But with the compounding, it can actually end up being more than typical, like stock market investments because, it's growing tax free. So, you have to earn more in the stock market to equal this, like a couple percentage points less in the policy since you have to take taxes into consideration.
And then what are the dividends?
The dividends are different with each company, and the dividends can change every year.
Okay.
Okay.
The company I use most actually doesn't declare the dividends every year because dividends don't really mean anything as far as the long term, because since they change every year, you can't really look at an illustration and know for sure what it's going to be. So that's why they don't bother declaring them. They don't bother trying to compete because we need to look at much more than just the dividend rates. We need to look at the performance of the company and a lot of different factors.
So is the dividend based on what they invested the money in, what they earn?
It's based on the performance of the company. It's like their investments plus mortality. Like there's a whole formula of different things that are involved in declaring the dividend.
Okay, thank you very much. I just wanted to make sure I understood what you said.
Great. Thanks, Jonna. Tina.
So I have a question in terms of the disability benefits. How does that work with this?
Well, you can actually, if you don't leverage the whole policy for your investing, if you use it like as an emergency fund, you can actually tap into it to replace your income while you're disabled. There's also riders that cover disability that are optional.
I see. Okay. Again, you're just borrowing against it.
Is that true? Are you borrowing against it, or are you actually taking money out of your cash value?
You would borrow against it.
Okay, thank you.
Thank you.
It's great. And we know, and Jonna's back with her hand up. Oh, good.
It's because that question drove another one. Kathy, I just want to make sure I understand, but I believe for disability, at least for your own disability, you can take part of the death benefits. Isn't that correct for disability?
Yeah, well, if you're chronically or terminally ill, then you can access a portion of the death benefit early.
Okay.
So if you access it, you wouldn't be borrowing against it. That would be decreasing the death benefit that's still available for your heirs.
And I think at one time you talked about what is it that you have when you go into a senior living kind of, that you could stop paying on the policy and you could take for assisted living, or that would be the same thing, right? You're taking money from the account.
Yeah, with a chronic or terminal illness.
And didn't you say at some point you could quit making payments to the policy?
Yep, after a certain amount of time, usually after 7 years, you have the option to stop paying into it, but the insurance will remain in force and you'll continue to earn the compounding growth. There wouldn't be any reason why I would suggest to stop paying into it because the more you put in, the more it's going to do for you, but you do have the options to stop paying into it after a certain amount of time.
Oh, great. Thank you. Hi, Bruce. Hi, David. Hi, Tyshawn. We're so glad to have you here. David, I don't see you with your hand up. That's unusual. And I know you got here a little late. Bruce, you got here a little bit late too.
Well, I got your message. I fixed your situation with the scheduling, so you're all set.
Thank you very much.
You're all set
Mhm.
now. I want to
We have,
make sure you're okay.
yeah, I'm perfectly fine. Thank you very much. Don got us set up. And did you hear about the whole life or the infinity banking? Did you hear everything about that? Is there something you'd like to hear that Kathy could repeat for you?
Um, I think she'd have to repeat the whole thing because I missed it all. So I'm
Oh,
sorry.
you did?
Don't,
Okay.
don't go over it again. It's fine. I'll catch up with you, I'm sure, later. I don't
Okay,
want
well, yeah, we're gonna send it out so you'll
yeah.
get a copy. David, did you have a question or Tyshawn?
Well, Happy New Year. Good to see everybody.
Thank
Happy New
you.
Year.
Thank
Yeah,
you.
I do. Thank
Happy
you so
New Year.
much. I did come in kind of late. I did a question reference to reinvesting the funds. What is the interest rate, and then when is the that come out of the account? That's yearly, is that correct?
Yes. Yeah, some of the companies charge it up front and some will charge it at the end of the year. So
So
it's
what would
around,
it be right? What would it be right now? To get started. I'm just curious, kind of the rates and what would it look like net wise from what you would be considering making this.
you would pay about 5% simple interest on the loan, but then your total cash value is going to remain the same. So you're going to be earning over 5% compounding interest right now. Well, 5% with the dividends on top of it. And the dividends are changing all the time. So this is actually the lowest the dividends have been. So since the interest rates are going back up, dividend rates tend to follow interest rates. So, if you go according to history, then dividend rates are likely going to go higher in the future.
So this won't be fixed, then it's just whatever
Right.
the rates are at the time.
The interest rate is
Just
fixed, but the dividends are adjustable and not guaranteed.
okay, thanks.
But it compounds and you're not borrowing from your account, you're borrowing against your account.
Right. You get
Just
to use
that's to me, that's a
other
huge
people's money
plus.
for your investments.
Yeah, because
It is.
that way there's no interruption on your earning.
Yep.
And you're earning twice if you're borrowing the money against your account and investing it in something that's doing 8, 10, 12% interest. So you're paying 3.5, but you're making 7, 6.5 plus.
Yep. You're getting a pretty good spread. Plus, you're basically earning infinite returns because you're not using your own money. So,
Yep. Well, that OP thing just popped in there, right? Other people's. Oh, Tina's got another question.
Yeah, I wanted to know when you put your money in, how soon are you able to borrow from it?
within the first 30 days,
Oh, okay. Okay.
the
And
first loan
I
can
know
take,
what, up to 75%? Is that it?
you can borrow up to 90 to 95% of your cash value,
Okay.
available cash value. I recommend leaving a little bit of a cushion, just in case, but you do have
Okay.
that option.
Thank you.
Mhm.
Okay, great. Anybody else have any questions about anything for Kathy?
And maybe I didn't answer that question right, because it's 90 to 95% of your available cash value, but your available cash value is not going to be 90% of what you put in. I mean, the policies are designed differently for different people based on their goals. So, like a lot of people will like the idea of only 10% of the premium going towards the death benefit and 90% just going towards extra cash because they want to be able to access as much of that cash as possible in the first year. But that does inhibit the policy in later years. So there's different factors that go into it. So this is more of a marathon rather than a sprint. So you want to look at long term, not just how much you can access in that very first year. But if there's a particular reason why you need more, then we can design it that way. Just all depends on your goals.
Can it change during the time of the policy?
Can it change? No.
Okay.
I mean,
because
well,
you said you could stop making payments. To me, that's a change. You could then use it for assisted living. That's a change. You're not paying anymore, and now you're actually using your own money or getting your money back to pay for your assisted living in some way. So I just see all those as different changes. good
Yeah.
changes. And then you can also borrow against the cash value. So even if
Mhm.
you set up an account that, as you said, has better advantages for the long term, there's still going to be a cash value somewhere, right? So if you
Right.
have like a
Yeah.
kid and you wanted to do something for your child, you would do the thing that was the long term, because by the time they got old enough to take advantage of that, they would be an adult and they would actually be able to think and do an investment properly, hopefully,
Right.
because they had the right
Yeah.
mentors.
Yeah. And it's a great way to teach your kids about money because instead of them just having their hand out, I need money for this, I need money for that, you teach them to borrow against their policy and then they pay it back and show them how by paying it back, they're just growing their money more so they can have more things in the future.
Right. So you teach them how to use this as a savings account also,
Yep.
as a
Yep.
savings, as banking, as being the bank. Put money
Yep.
in, take money out.
Yep. And you can be like the family banks. So eventually, as the policies get bigger and bigger, you can actually start being hold the mortgage for family members and charge them interest. And they think, well, why should I pay my mom interest or whatever it is? But the interest that they're paying is just going back into their account, basically. They're paying interest in the insurance company, but it's growing more. So they can see that as they pay it back, all they're doing is replenishing that cash value to be able to use again and again.
Yes, to use again and again.
And the higher the interest they pay, it's not really interest because the 5% interest goes to the insurance company, but charge yourself like an extra 5% interest or whatever that
Sure.
just pays them back faster.
Right. Well, if you do that, have to talk to your tax accountant on how you can make that tax deductible. Okay, one more creative way to talk to your accountant,
Yep,
because they'll make sure you don't break any rules.
that's right.
Any other questions or comments? Kathy, this has just been an amazing, thank you very much. This has been fun and great, and so happy to have you here, and we hope you'll come back again. Each time
Yeah.
you come, you bring a new story and presenting in a different way. So it's just always so interesting when you're here with us. So thank you very much.
Well, thank you so much for having me.